Today on InvestTalk, we look at the surprise jobs report miss, then we break down how that impacted markets today. We answer questions about WD-40, ZBRA technologies, and annuities. And then at the end, I look at the yen carry trade unwind and how it could have more room to run.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point today is really about the story of the day, which was the July jobs report. And it came in a bit worse than expected. Now, the market kind of acted like it was horrendous. I wouldn't say it was horrendous, but it was certainly a miss. We added, the BLS said the labor market added 114,000 jobs in July. That was down from 175,000 that the market had expected, and 179,000 that was added in June. So down from 179 to 114. The unemployment rate ticked up from 4.1 to 4.3. The economist average expectation was that to stay flat at 4.1%. Now, interesting, the BLS said that the Hurricane Beryl had no discernible effect on the employment data for July. I don't know if I really believe that. We'll see next month, see if we get any revisions, things like that. But that was an interesting note. Now, on the wage front, it slowed from 3.9% growth to 3.6% year over year, and wages increased month over month, 0.2%. That was less than the 0.3 in June. And this really makes the September rate cut inevitable. And there is a ton of speculation now that it won't just be a 25 basis point cut, it'll be a 50 basis point cut. In fact, the odds market has a 69% chance that it will be a 50 basis point cut by September 18th. And only a 31% chance there'll be one, just a 25% basis, 25 basis point cut. So, and you all the way out to December, you have a 43.7% chance that there will be there will be 100 basis points of cuts. 125 basis points of cuts, because that's 400 to 425. And now we're at 525 to 550. And there's an 18% chance go all the way from 375 to 400, which would be 150 basis points of cuts. And there's only 3 more meetings left. So the market is saying that in at least one of these meetings, there will be a 50 basis point cut. And it's kind of saying, hey, probably 50 basis points September, 25 in November, December. Now, that gets a bit hairy because you're right in the heart of election season. September and November, October and November is the heart of the election season, and there will certainly be jabs that they are being political. But it's pretty clear from the economic data, it's necessary, okay? Now, this comes after Thursday's report of 249,000 initial jobless claims in the week of July 27th. That's up from 235 the week prior, but the highest level since August of last year, so the highest number in a year. And most importantly, the continuing claims for unemployment, that also accelerated back to the upside and hit the highest level in 2.5 years, okay, over 2.5 years. So it's pretty clear the labor market is weakening. But that's something the Fed kind of knew, okay? They talked about it at the meeting on Wednesday, Fed Powell did, and he said they think that it's a process of normalization. But, quote, if we start to see something that looks a bit more than that, then we're well positioned to respond. That's basically saying, if it suddenly becomes no longer gradual weakening of the labor market, we will do more than just the 25 basis point cut. And that's kind of what the market is saying now and saying, hey, this is more than just that. Now, would I say that's true? I'm on the fence. I would like to see another data point that, for the month of August, right? That'll come out in early September to make sure that, that hurricane really wasn't kind of screwing with the numbers. Okay. So it'll be interesting. That'll be even more important to see what's happening in the month of August, about a month from now. Okay. And then this did trigger the Psalm rule, which I think is a bit overrated, to be honest with you. Jerome Powell thinks it's a bit overrated. He says it's not an economic rule where it tells you something must happen. And I kind of agree with that. So I do think that's a bit overblown. But that was the jobs report. And that's what kind of continued to unwind that yen carry trade, which we'll talk about in a little bit. and created more volatility in markets and had the small caps selling off a bit more because obviously if there is a recession, there's a higher likelihood there will be a recession. You did see credit spreads widening out a good amount today. And all of that typically does hit the small caps, and you saw that. But we'll see if we get a bounce into next week. And remember, we also have Jackson Hole coming up. So this is, and we won't have that August number by the time that happens. Usually, the Jackson Hole, I forgot the date, it's usually late August. And that's usually a time where policymakers start to set some intention for the next phase in the policy regime, and that is an easing cycle. And so there'll be a lot more, I think, signaling if there is going to be a 50 basis point cut in September. And remember, the market will fully price that in. So don't think that the market's going to get surprised. It won't. There will be signaling from the Fed, and we'll kind of know. And right now, I think the signaling does show that a 50 basis point cut could be in the cards for the month of September.
1 minute.
Now let's take a look at the market today. It was another bloody day on the backs of that poor jobs report, which we'll dig into the details here in a little bit. But what you had was really the growth side continuing to take it on the chin. Now the whole market took it on the chin, and small caps were worse than the large caps for the second day in a row. And as set the Russell 2000 back to really the levels, almost the levels where it had that breakout back on July 11th, okay? Where basically where we were at the close of July 11th, the first move in the Russell. But overall, it's still in an uptrend. Where if you look at the Qs or the S&P, that is, as a technical picture, that's certainly more precarious. The NASDAQ is now below the 100-day moving average. The S&P is right at the 100-day moving average, bounced off it a little bit today. And I expect probably a bounce near term. So at let's just say some point in August. But I do expect another leg lower, probably into October, November timeframe. And that will likely be the low for the year. Obviously, a lot depends on election outcomes, monetary policy, fiscal policy, etc. But that's kind of my base case at the moment. This is something I've been talking about for really since the beginning of the quarter, that this is a time where you're likely to get a bit more volatility. But in general, liquidity continues to be positive worldwide, and lifts asset prices. But when you get an unwind of a trade, meaning forced sellers, when there's a trade is being unwound, that means these traders and these investors are positioned the wrong way, and they are forced to leave, meaning they're going to sell at whatever price. Okay, and so that's kind of what's happening now with that unwind of the yen carry trade. So very interesting to continue to see the large cap tech sell off. NVIDIA down 5.75% today, 6.8% for AMD, Tesla down 5%. And so, it's a very interesting market out there. Amazon was down big as well, down 8.78% today. So I continue to see a lot of weakness there. Apple was the only one that kind of bucked the trend. They had earnings that were not great, but were a bit better than the market expected. So that continues to be kind of a safe haven. And I've said throughout the years, out of all the Mag 7 stocks, Apple is by far head and shoulders above the rest. It's really not close. And a lot of people will say NVIDIA, but no, not at all. Think of how long Apple has been around, the success and stability of that platform. Their revenue from subscriptions went up despite iPhone sales dipping a little bit. So it's pretty clear that Apple is just the strongest head and shoulders above all the rest. And you're getting more volatility, especially in the semiconductor space. The SMH, which is a good proxy, that's the semiconductors ETF, that peaked at about 282, and now we're already at 218. Big move, approaching the 200-day moving average. So that's really where the major sell-off is happening in markets. And I think we are still set for more choppiness, and you could have very big rip your face off rallies like you did 2 days ago, right? Market was up big on Wednesday. So it's a very interesting time, but ultimately likely still a buying opportunity.
Hi, I was calling regarding the WD-40 company, Whiskey Delta Foxtrot Charlie. I was just curious to see if this would be a good entry point and if this is a good company to invest in. I appreciate it.
All right, looking at WD-40, most of you probably know the brand. Almost everybody has a can in their house. I have a couple different types of WD-40 in mine. But they make lubricants and cleaning products, and degreasers, rust removers, bicycle maintenance products, etc. And it's the most widely known brand in this space. It would be considered a consumer staple. And it is a very good business. But as everything, just because it's a good business doesn't mean that it is the right time to buy or it is an attractive investment today. Because it's all about how much you're paying for that business. Now, a good business is rarely going to trade at a cheap price. So most of the cheap companies you're finding out there, they look, oh my God, these multiples are egregiously low. There's probably something wrong that you're missing, okay? Because usually, especially in a market like this, the quality names are trading at a premium. But is this premium low enough to make it worthwhile? Now, on the profitability front, 32% return on equity, 21% return on invested capital. Both of those very, very good numbers and around kind of the long-term average. Okay. 1.5, roughly 1 1/3 dividend yield, solid, not amazing, but in quality businesses, you're not looking for huge dividend yields. It's not what you're looking for, right? You're looking for consistent cash flow and profitability. And a good balance sheet. And this certainly has a good balance sheet as well. Very little debt. However, so the big however, it's trading at really high multiples and borderline egregious multiples for the level of growth that you get here. Okay. Last year, they made $4.83. That was down 1% from the prior year. And in 2018, pre-pandemic, they made $4.64. So from $4.64 to $4.83 in the span of what? What's that? 6 years? That's not a lot of growth. Now, earnings are supposed to go up 8% this year, 9% next year. You're talking like a 5-year earnings growth of mid-single digits, maybe? So what type of multiple would you pay for that? Typically, that type of multiple would be somewhere in the high teens to low 20s P/E ratio. Okay, somewhere around a market multiple, and it can fluctuate depending on the quality of the business. So I'd say, okay, I might pay low 20s because of the quality of the balance sheet and quality of profitability. However, what is it trading at now? Over double that, 50 times. And if you even go based on forward-looking earnings, it's at 45 times. So it's over double the multiple I would be willing to pay. And you start looking at other aspects like enterprise value to EBITDA, that's at 34. Usually like to see that around the 10 mark, okay, or lower. It's at 34, near the all-time high that this has ever traded at. And the technicals, if I zoom out to a weekly chart, it peaked back in the beginning of 2021. And yes, it's rallied with other growth stocks, high multiple stocks, but it's losing steam once again. So certainly a name that should be on the watch list. It's not a huge name, but it's a well-known name, $3.5 billion market cap. But it would need to be cut in half. Talking low 100s, that's the area that I would be picking up WD-40. Until then, it's just an overvalued quality name. Thanks for the call. Now we're going into a short break, and on the other side, I'll talk about today's planned topics. But please remember, you can call anytime and leave your question on the InvestTalk voice bank. And if you're listening via our live stream or on AM 1220 radio in the Silicon Valley area, you can call right now at 888-99-CHART. Now we have a lot of ground to cover over the next 45 minutes. The yen carry trade, I've been harping on this for about a week now, and it is really the biggest story. And it's very interesting because this rarely happens where two major central banks are pivoting at the same time. And even more rare when it's in the opposite direction. So we'll look at that story. And also the oil industry, oil and gas, in a new Trump presidency versus a Harris presidency. A lot of people think that it's clear cut. Trump would be better for the oil industry and Harris would be bad. But history says that it's a lot more complicated than that. So we'll look into that story as well and try to unpack what exactly it means for the oil industry, depending on who may be elected. Okay. We also have some voice bank questions, one on ZBRA technologies and the other on AIO. It's an artificial intelligence ETF. Now, we also have questions submitted via the comment section over on our YouTube channel. We get to those as well. And of course, we welcome your finance and investment questions right now. So give me a call at 888-99-CHART.
Hey, y'all. Appreciate what you do. This is Django out of Charleston, South Carolina. I had a question about ticker symbol AIO. Just wanted to get your thoughts, some feedback on it. I didn't find too much information on my end for holdings or what they're investing into exactly. Love some feedback. Have a great day. Appreciate what you do. Rest in peace, Steve.
All right, this is Virtus AI and Tech Opportunities Fund. AIO is the symbol. And as you would imagine, it's heavily tech, 45% tech. And your top holdings are NVIDIA, Microsoft, Eli Lilly is third, Hilton Worldwide is in there, but Broadcom, Cadence Design Systems, Meta, Oracle, JP Morgan Chase, and Cigna. Those are the top 10. And this is in the exact opposite place you want to be. This is all large cap growth. And as I've said for a while now, this is not an area. This is, everyone's over positioned. You do not want to be, you want to be leaning mid and small cap value, not large cap growth. The unwind is here. It's just getting started, frankly. And this is actually a good short, to be honest with you. Not something you want to own. Okay. Now let's briefly mention the newest KPP Premium newsletter that comes out tomorrow. In the KPP Insight section, we discuss the labor market, stock ideas about 2 gold mining companies, and in the portfolio management section, we touch on tax loss harvesting. If you're interested in learning more, visit investtalk.com and subscribe. The newsletter comes to your inbox on Saturdays. Okay. Now, the next Invest Talk, we'll look into this topic. 2024 average 401k balance by age. Are you saving enough? Understanding how your retirement savings compare to others can provide valuable insights into your financial planning. That's Monday, but for now, I'm Justin Klein. I'm ready to take your calls at 888-99-CHART.
Hey, Justin or Luke, this is Andrew from Atlanta. I wanted to call you guys about ZBRA Technologies, ZBRA. I've been holding this for a while. I'm up about 5.22%. If you could please tell me what your projections are for this stock, greatly appreciate your help, and I hope you have a good day. Thank you.
All right, looking at ZBRA Technologies, and for everyone else out there, what they do is they make automatic identification and data capture technology for enterprises. So think for retail facilities, transportation, logistics, manufacturing. It's really about improving efficiency of its customers, basically by tagging products and capturing that data and the flow of those products. And so, workflow automation software, for example, barcode scanners, mobile computers, etc. So very good business, though. Very, very good business. $16 billion market cap. Free cash flow about $4.4 billion. But what I like is that earnings are expected to accelerate next year, up 30% and 22% the year after. So while the last year has been a bit rough, earnings are accelerating back to kind of pre-pandemic trends, which I like. Now, it has reversed recently, so the technicals are a bit rough near term, but I would be probably buying this on the dip. Why is that? Because they have a good balance sheet, only about $2.5 billion in net debt. They're taking their cash flow and they're buying back shares. So I like that. No dividend. Okay. But dividends are overrated, to be honest with you. But the profitability is good. Return equity is low now, but historically it's much higher. It's usually return equity in the mid to high teens. And I like that. So I would be buying ZBRA on the dip. You're up on it. You already own it. I wouldn't really be selling it. I'd probably be looking for a place to add to it if you have room in your portfolio to up your allocation. Okay. Thanks for the call. Now let's talk about the oil industry and the presidential race. This is not a show where we talk politics, but we have to talk politics when it could impact the markets or impact industries. And a lot of people think, if Trump is elected again, he is good for the oil industry. And if Harris isn't, or is the president, she would be bad for the oil industry, okay? Because she's previously had support for banning fracking, for example. Okay, but figuring out which politician is better for the industry is a lot trickier. Just because Trump is friendlier to an industry doesn't mean that automatically makes them more profitable. In fact, if you think about it, if you remove barriers to drilling, you build pipelines that can help the growth of supply, that can put pressure on prices and thus industry profits. Okay. And what typically happens when you lower the cost of doing business, it helps smaller players, smaller drillers, actually put pipes in the ground, put holes in the ground to pull more supply out. And it's an industry historically that has poor discipline. They chase after growth. Now, there's been some changes in the industry that's more focused on profitability, and I think that's generally a positive. So I don't think there's going to be as much of people have PTSD, and the whole industry did after oil went negative during the pandemic, and you had the big drop in oil in 2016, et cetera. So there was there were bankruptcies, and a lot of the industry learned, but not everyone did. Okay, now the industry's performance during the Biden administration currently is actually very positive. The combined free cash flow of the 10 largest components of the S&P Oil and Gas E&P Index in the first 3 years of the Biden term was 3 times what it was during all 4 years under Trump. Now, a big factor in that is the war in Ukraine. And capital discipline is big as well. Large producers are expected to devote the same amount of CapEx under Biden as they did in the Trump term, even with oil prices higher. So typically when you oil prices higher, they spend more, they do more CapEx, but they're not really doing that. They're reacting to higher prices, okay? And that's generally keeping profitability and prices relatively steady, okay? And it's encouraged restraint for a lot of the industry. Now, last term, Trump was really unpredictable. There were some things that were good for the industry overall in supply, but others not. For example, the Chinese tariffs. China imposed a 25% tariff on U.S. LNG, liquefied natural gas, and obviously that was bad for LNG market and those selling natural gas, trying to get natural gas out to the rest of the world. Now, oil prices also were lower because he asked Saudi Arabia to produce more, pushed over supply, and dropped prices. And he also flip-flopped on offshore drilling. First, he opened it up, and then he put ban on offshore drilling off the coast of Florida and Georgia. So it's kind of a mixed bag. And a Harris administration could be the same. A mixed bag. Yes, could put more headaches for fossil fuel companies, favor green policies, but she also directed the Department of Justice to go after oil and companies that directly contribute to global warming. And I think that's probably a bridge too far for most people and for courts, and it would probably fall on deaf ears. And recently she walked back her fracking ban claim. But overall, it's still either one could go either way. It's not a clear-cut choice based on their domestic policies. And then you get into foreign policy. A Harris administration would probably keep a status quo of what's happening right now with Iran, with Russia, with the Middle East, etc. Trump, he's had a friendly relationship with Saudi Arabia. So he could actually push prices down by getting OPEC to open their spigots again. Okay. So, and what is he going to do with the geopolitical situation with all the different wars out there and Russia? So what I'm basically saying is don't think it's clear cut. You have to read the policies as they are enacted. And law of supply and demand are going to rule everything, though, right? No amount of policy, no matter who is in the White House, is going to buck the downtrend in oil prices during the COVID shutdowns because the whole world economy was shut down. And so, while it's often people make simple, straightforward judgments on how policy will affect industries. In many industries like oil and gas, where there's so many factors involved, it's very difficult to pin that down. So don't tie yourself to any one opinion and be open to changing no matter who could be elected. Now, this is InvestTalk. Let's keep things moving and play another question at 888-99-CHART.
Hi, Justin and Luke. A long-time listener here from the Midwest. Love the show. Thank you guys for everything you do. Hey, I have a quick question. Listening last week and heard Luke mention that maybe a worldwide fund wouldn't be a bad thing to get into at this point of time. I don't have any worldwide ETFs or, I have stocks that I guess are worldwide, but no ETFs or anything worldwide exposure. I was looking at the Vanguard. They have a worldwide ETF, but then I found these two, and I was wondering what you guys think of these two. WWW is the one, and then FNDF is the other one. I don't know. Both of them looked okay, but I was wondering which one you thought would be the better of those two, or should I just stick with Vanguard because those are always safe? Thank you for your help. Look forward to hearing your response on the show. Have a good day.
All right, well, the first thing is no equity is safe. I don't care if it's a Vanguard, Schwab, you're buying international or worldwide ETFs. These are filled with companies. You saw today, right, where funds, you could look at any Vanguard fund. It's going to be down, right? VTV, for example, Vanguard Value Fund. What was it down today? 2.5%. Okay. So don't think anything is safe. Okay. Nothing is completely safe. Safety is for treasuries. Okay. So understand that first off. And I always say treasuries, short-term treasuries. Okay. Now, when you get to worldwide, and this is another lesson here is you gave me one symbol, WWW. This is Wolverine worldwide. And the name, worldwide. But this is not a worldwide, this is not a world ETF or anything. This is a company that is engaged in designing, manufacturing, sourcing, marketing, branded footwear. It's a footwear company. They make, what's their main brand? Forget exactly. Not Uggs. Anyway, they make footwear. So this is an individual company. This is not something that you're getting you international exposure. Now, FNDF it's a Schwab Fundamental International Equity ETF. It gets 4 stars from Morningstar. It has a fairly good mix, only 8% technology. I love that. 16% in industrial, 19% financial services, 10% basic materials. Much better overall allocation from a sector perspective than, say, the S&P. And it is really a large cap value fund. And so it's certainly going to outperform. If the dollar continues to weaken, it's going to do better as well. So, I think that's good. I don't have the Vanguard one in front of me because you didn't give me the symbol. But this one's solid. It's a good way to get exposure to international stocks. Remember, when you're seeing world funds, however, that's typically U.S. and international. So make sure that you're not overlapping with a lot of domestic exposure when you're buying a world fund. If you want international exposure, buy an international fund of some kind like FNDF. It's solid. I don't have a better one out there, but it's a solid large cap international value fund. Thanks for the call. Now on Fridays, we generally make it time for a quick rundown of some key benchmarks and pretty big moves this week. The 2-year yield, 3.88%, a new 52-week low. Last week, it was at 4.38. Yes, that is a 50 basis point move in 1 week on the 2-year. Okay. And that's, especially in the bond market, it's usually not the level that the rate is at, but the swiftness of the move. And you've seen a lot of swift moves in markets this week. The 10-year, 3.8%. And it was at 4.2% 1 week ago. So a 40 basis point move on the 10-year long duration asset. So you can see, actually, the yield curve did steepen. Remember, because the short rates went down more than the long rates. That is a steepener. Okay. Gold prices, $24.41, up from $2,383 last week. And 126 weeks ago, it was $1,806. So it continues to be in a nice long-term uptrend. Same with silver prices, $28.56 per ounce, $28.56, up from $27.80 last week, and up from $23.94 119 weeks ago. Oil was down a bit to $74 per barrel from almost $77 a barrel last week. A national average for gasoline, $3.48. That's down from 61 weeks ago at $3.56. So you're definitely seeing a decline in gasoline prices because of oil prices coming down. The average here in California, $4.64. But that was a quick rundown of some big moves in markets, especially on the rate front. Okay. Now, I hope you've been telling your friends that the InvestTalk podcast is available in video form over on our YouTube channel. And we are going to take a quick question. Now, Mike Matthews says, Justin, on yesterday's show, you strongly advised against annuities. I've heard you and other CFPs saying the same thing. What if you already have a portfolio of stocks and you keep a smaller amount of money in an annuity as a rainy day fund? In other words, if everything else goes pear-shaped, you've got something insured that will always be there for you no matter what happens in markets. This would be a small amount. The majority of your investments are overall in the stock market. Would a small amount be okay in an annuity, or should even that be put into a different investment tool? And which one? The simple answer is liquidity. Right? Annuities, they're not liquid. So you're talking about a rainy day fund. How are you going to tap that? Okay. Now, there might be some where you say, oh, you can borrow against it, right? They do that with the whole or universal life policies. Oh, you can borrow against it. You can be your own bank. No, it's dumb. Okay. If you want a rainy day fund, go buy short-term treasuries. That's safe, right? You have no currency risk because it's in dollars. Your expenses are probably in dollars, right? You're getting some, right? That rate might come down in the near term, but that's a rainy day fund. It's going to earn what cash earns. Okay. But it's not going to be volatile, and you're going to have that. If everything goes pear-shaped, you have that. Okay. And what I'm consistently saying over the past few years is learn about what happened in 2008, what happened during COVID, and the response to that. And tell me whether the government is going to allow those types of situations to spiral out of control, or are they going to err on the side of creating more inflation? Remember, having cash, having safety assets, okay, that are insured from a big drop, that is an insurance from a deflationary bust. And do you think that the government can allow a deflationary bust without bankrupting the whole, treasury? The answer is simply no. And so actually the risk is on the upside that things will go into a crack up boom. And I think that's what we're in. So hope that helps. Now, this is InvestTalk. I'm Justin Klein. We have one goal here each and every weekday. It's to help you become a better investor. So I'm ready for your calls at 888-99-CHART. Now, in March, the Bank of Japan exited its negative interest rate regime that they were in for a decade plus. And a big reason for that was inflation started to take off. And as of June, their CPI, their prices rose 2.8% year over year. And that doesn't sound like a lot, but for Japan, who's been in a deflationary struggle for nearly 3 decades, that's much higher than they're accustomed to. And this has sparked a shift towards higher rates. And on, was it Wednesday? They raised rates by 0.25%, so 25 basis points. The market was expecting only 15 basis points. Okay, there was a 41% probability the Bank of Japan would raise rates by 15 basis points, but they did 25 basis points. Okay, and what you're seeing right now is an unwind of the yen carry trade. It is by far the most important topic in markets right now because hedge funds ramped up their short bets on the yen over the past few years, especially the past 2 years when they were staying at zero and the Fed was ramping rates higher. And they were able to make the spread between what you could borrow at in yen between 0 and say 1%, and then invested in things like treasuries earning 5%, for example, on short-term treasuries. And this is a common practice. It's not something new. It's been going on for 2 decades now. So the yen carry trade has been very popular. And now that these central banks are shifting gears at the same time and in opposite directions, the yen is rallying. The unwinding of those trades is happening. Okay. Now, the big question is, how far will each side allow it to go? Because the Fed could get a bit more hawkish and keep the dollar stronger, and the Bank of Japan could get more dovish and be patient on those rates hikes, future rate hikes. And I think it's likely the latter, because if the yen appreciates too much, that hurts exporters, and they're in perpetual fear of returning to deflation, which they were in for so long. Okay. Now, over the long run, a narrowing of the differential between Bank of Japan rates and the rates here is going to shift investment flows away from the yen carry trade and into other assets. Currently, the spread has gone from 4.2% to closer to 2.5%. And that gap narrows. And so what that means when you execute the yen carry trade, if the yen appreciates by 2.5%, now you break even. Okay. Much smaller room for error than the 4.2% just a few back in October. Okay. Now, this is a very important dynamic to continue to follow, not just because of the investment flows it's creating, but the fact that there could be a lot more to come. Why? Because what is called the Big Mac Index. Now, this is put out by The Economist, and it ranks basically how much a Big Mac costs in the US versus in another country. And according to the Big Mac Index, the yen is undervalued by 44%, which means that, over the long run, based on purchasing power parity, this is a basic concept you learn in economics class, that over the long run, prices and currencies should gradually move towards parity based on the consumption patterns of the country, if the consumption patterns are the same. Okay. And since everybody across the world eats Big Macs in some way, shape, or form, right? Every population, shall we say, the Big Mac Index is a good way to look at it. And so based on that, Japan, the yen could continue to appreciate and create more unwinding of that carry trade and get closer to purchasing power parity. And we'll continue to watch how that evolves into next week. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. InvestTalk. Good night.